Welcome back to the deep dive. Today, we're tackling something really fundamental, something I think a lot of people feel maybe intimidated by.
Yeah, absolutely.
We're doing a thorough exploration of how you can start your investment journey from, well, absolute zero. We want to cut through the noise.
All the jargon.
Exactly. The complexity, the jargon that just seems to cloud this whole topic.
And it's crucial work because, let's be honest.
Yeah.
Investing used to feel like this exclusive club, right?
Mhm.
Super opaque.
Totally. Like you needed a secret handshake or something.
Yeah, or, tons of money already or some deep financial background. But the landscape has, thankfully, really shifted.
That's the good news.
Technology, education,
Yeah.
the barriers are definitely coming down. Our sources today really show that.
They really do. We've pulled together what feel like two really practical guides. Together, they kind of create a comprehensive playbook for you, the listener.
Okay.
So the first source is very much a step-by-step roadmap for personal investing, how to actually grow the capital you have.
Right, the how-to.
And the second, it's quite different. It's more about aggressive, high-stakes strategies for breaking into finance itself.
Investing in your career to boost the income side.
Precisely. How to invest in yourself, basically, to dramatically boost your earning potential, which obviously fuels your future investments.
So it's a two-pronged attack, really. Strategies for the money you've got, and maybe even more importantly, strategies to get more capital coming in.
Yeah, you can't really be a great long-term investor if your main income engine isn't firing on all cylinders, right?
Makes sense. You need fuel for the fire.
So if you've ever felt intimidated by, like, the stock market tickers flashing on TV or financial news, this is really for you.
We're starting from square one.
And we're kicking off with this really powerful idea from the source material. You don't need to be rich to invest. You invest to get rich.
I like that. It flips the script.
It really does. And that accessibility, that's our mission today. We want to give you clear, actionable steps to just jump in.
Okay, let's do it. Where do we start? The first barrier
Yeah.
is often just in your head.
The psychological one.
Here we need to build that mindset that gets you beyond just, basic saving.
Okay, so if we're talking absolute zero, the default for most people is just saving, right? Sticking money in a checking account, maybe a savings account, getting like 0 point something % interest. Why is that just not enough anymore? Fundamentally.
Well, fundamentally, simple saving is actually a guaranteed way to lose money over time.
Guaranteed. How so?
Inflation. It's
Yep.
the silent killer of savings. The whole point of managing money intelligently isn't just keeping it safe, it's making it grow.
Okay.
So if your savings account gives you, say, 1% interest, but the cost of everything else, groceries, rent, gas, goes up by 4%.
Which is inflation.
Exactly, that's inflation. Your money is actually losing 3% of its buying power every single year. You're getting a negative return in real terms, guaranteed.
Wow. Okay, that completely reframes it. So investing isn't just about chasing huge returns. It's actually about protecting what you'll be able to buy in the future.
Precisely. Protecting your future purchasing power. And realizing that leads straight to the very first actionable step.
Yeah.
You absolutely have to commit to learning.
Learning. Okay.
Yeah, becoming an investor means you need to build up a toolkit of knowledge. You got to understand the basic concepts, the different strategies, even the psychology behind it all, how markets actually work.
Right. So you can't just throw money at something and hope for the best. You need a foundation.
Definitely not. That learning toolkit is mandatory before you put a single dollar or euro or pound into the market. And our source has actually put together a great reading list.
Oh, yeah. The books.
Yeah, highly recommended stuff covering the whole spectrum.
What's on the list for someone starting out?
Okay, so for the absolute bedrock, the fundamentals, you've got The Intelligent Investor by Benjamin Graham.
The class.
The classic. It teaches value investing, like the philosophy of buying assets for less than they're truly worth. It's dense, not gonna lie.
Yeah, I've heard.
But it teaches you how to think like an owner of a business, not just a gambler on stock prices.
Okay, so Graham gives you the why and the structure. What's next?
Well, the sources suggest following that with Beating the Street by Peter Lynch. He's much more relatable, accessible.
Yeah, more practical maybe.
Yeah, he shows how regular people can find great investments just by paying attention to the companies they already know and interact with every day.
I like that. And you mentioned psychology.
Big time. Because honestly, the biggest risk to your money is often your own emotions.
Fear and greed.
Exactly. Fear and greed. So The Behavioral Investor by Daniel Crosby is crucial. It helps you understand and manage those biases that make people, buy high and sell low.
Okay, essential stuff. Anything for someone who feels totally overwhelmed by all this.
Yeah, for that, there's Broke Millennial Takes on Investing by Aaron Lowry. It's very clear, jargon-free, gets you right into the basics of opening an account and taking those first steps.
Nice. So that reading list covers theory, practice, and the mental game. Good foundation.
Definitely. Okay, so you've committed to learning. The second step is setting realistic goals and timelines. This is where people often trip up. Vague goals are kind of useless.
Right. I want to be rich isn't really a plan.
Not at all. You need to define, with real clarity, why you're investing. What's the specific target?
So listeners, challenge yourself here. Don't just say get rich. Think, I need X amount for a house down payment in 7 years. Or maybe, I want to cover university costs starting in 18 years.
Exactly, because knowing the why immediately tells you the how. A 7-year goal needs a very different approach, different risk level, different investments than a 30-year retirement goal.
Makes sense.
Your goals have to be realistic about the money you can put in, the time you have, and the amount of risk you're comfortable taking. Expecting 20% returns from super safe bonds in 2 years. That's just setting yourself up for failure.
Totally. Okay, learning, setting goals. Now, before we even think about putting money in, what about the safety net, the prerequisites?
Yes, the absolute must-dos before you deploy any capital. This is the foundation, and skipping it is a huge mistake for beginners.
Okay, what are they?
2 main things. Actionable step 1. Pay off short-term, high-interest debt.
High interest debt. So we're talking credit cards, payday loans, that kind of thing, not necessarily student loans or a mortgage.
Exactly. That's a key distinction. We're targeting the really expensive debt first. If your credit card charges you 20% interest, well, think about it.
Yeah.
Paying that off is like getting a guaranteed tax-free 20% return on your money. No investment strategy can safely promise that year after year. Mathematically, it's the best investment you can make initially.
Wow, framing it as a guaranteed return. That's powerful. Okay, so high interest debt first. What's actionable step 2?
Build an emergency fund. This needs to be cash, easily accessible. Think a high-yield savings account, not tied up in investments.
How much?
Typically enough to cover 3 to 6 months of your essential living expenses. Rent, food, utilities, basic bills.
And why is this absolutely non-negotiable before investing?
Because life happens, right? You might lose your job, face a big medical bill, your car breaks down. Unexpected stuff.
Always.
If you don't have that cash cushion, guess what? You'll be forced to sell your investments to cover the emergency. And that usually happens at the worst possible time, like during a market crash.
So you lock in losses and wreck your long-term plan.
Precisely. The emergency fund stops a market crisis from becoming a personal financial crisis.
Got it. Debt tackled, emergency fund built.
Right.
Now, the final foundation piece, figuring out your risk appetite. This drives the whole strategy.
It's absolutely. Your tolerance for risk, the sources break it down into 3 things that all connect.
Okay, what are they?
Factor 1 is the type of investment. Are you comfortable with volatile stocks, or do you need the stability of, say, government bonds?
Factor 2.
Your time horizon. How long can you leave the money untouched? Is this for next year's vacation or for retirement in 40 years?
Yeah.
Big difference.
Huge. And the third factor.
This one's really about your own psychology.
Yeah.
The level of potential loss you can actually stomach without panicking.
Right. Like if the market drops 10% and you feel sick and want to sell everything immediately.
Then your portfolio is probably too risky for your actual comfort level, regardless of what you thought your tolerance was. You need to adjust towards more stability.
And that often ties back to the time horizon, doesn't it?
Directly. If you're 25 with decades until retirement, you can mentally handle a 50% drop knowing you have time to recover. If you're 55 and retiring in 5 years, a 50% drop could be catastrophic. You just can't take that risk.
So the goal is finding that sweet spot between the investment type, the time frame, and your gut feeling, all aiming for your goal return without freaking out.
That's the balancing act. Find the right balance to hit your target without triggering those emotional mistakes.
Okay, foundation's built, mindset's shifted. Let's get into the how-to, the actual execution. And this roadmap really starts with the most powerful force in investing.
Time. And compounding.
The magic of compounding, yeah.
It's almost unbelievable how much difference starting early makes. The younger you start, the better your odds of hitting a really significant return over the long haul.
Give us an example, like numbers.
Okay, say you invest $10,000 when you're 25. If it grows at an average of 8% per year, which is historically reasonable for stocks that are not guaranteed,
Right.
by the time you're 65, That single $10,000 investment could be worth over $217,000.
Wow, just from 10K.
But if you wait until you're 35 to invest that same $10,000, at 65, it's only grown to about $100,000.
That's less than half, just from waiting 10 years.
That's the brutal cost of delay. It's huge, compounded over time. Time is your biggest asset as an investor.
So time is the engine. And how long you plan to invest dictates the whole strategy, right? Long horizon versus short horizon.
Absolutely. If you've got a long runway, say 20 years or more, your main focus should be on maximizing the expected return,
Which usually means?
taking on equity exposure. Stocks, shares, whatever you call them. Historically, they've given the best returns over long periods.
But they're more volatile.
Exactly. Higher highs, lower lows along the way. But for a beginner, say someone who's 25, putting maybe 80% or even more into equities makes sense because they have decades to ride out the inevitable dips and recover.
Okay, but what happens as you get closer to needing the money? Say retirement is just 5 years away. You can't have 80% in stocks then, right?
Definitely not. The strategy has to shift as the timeline shrinks.
Right.
You need to progressively de-risk. That's the rotation strategy our sources talk about.
Rotation strategy. Explain that.
You shift your focus from chasing high returns to protecting your capital. Stability becomes key.
So you sell some stocks?
Yeah, you gradually sell off the riskier assets, like stocks, and rotate that money into more stable things. Think fixed income, like high-quality bonds, or even just cash equivalents.
Why is that rotation so critical near the end?
To avoid what's called a severe drawdown, a sudden big drop in your portfolio's value right before you need the cash. Imagine planning to retire next year, and the stock market crashes by 30%.
Oof. Nightmare scenario.
A proper rotation strategy protects you from that happening right when you can least afford it.
Okay, timeline sorted, rotation understood. Next up, choosing the actual investments. You mentioned stocks and bonds, but it's broader than that, right?
Oh yeah. We need to think beyond just buying individual stocks, especially for beginners. Diversification is key, and there are instruments that help with that.
Let's break down the main options for someone starting out. Highest risk, potentially highest reward first. Shares, individual stocks.
Right. Buying shares of specific companies listed on exchanges like the NYSE or Euronext LSEG over here.
What's the main risk there?
It's volatile, requires a lot of research, and the risk is very concentrated. If that one company you picked hits serious trouble, you could lose a huge chunk or even all of your investment in it. You really need to understand the business you're buying.
Which is exactly why, for most beginners, the sources strongly lean towards
ETFs, exchange-traded funds. They've really become the go-to starting point.
the great equalizer, you called them. Lower risk than individual stocks.
Generally, yes, because of what they are. An ETF is basically a basket of securities. It could hold hundreds or even thousands of stocks or bonds or commodities. But it trades just like a single stock on the exchange throughout the day.
So instead of picking one winner, you're buying a piece of the whole market or whole sector.
Exactly. Instant diversification.
What are the specific advantages for a beginner using ETFs?
Okay, number one, diversification, like we said, even with small amounts of money. Two, they're highly liquid, easy to buy and sell quickly. Three, and this is huge, generally very low costs, low expense ratios.
Expense ratio, that's the annual fee?
Yeah, the fund manager charges. For many ETFs that just track an index, like the S&P 500, the fee can be incredibly low, like fractions of a percent, much lower than traditional mutual funds often are.
And those tiny fee differences add up massively over time with compounding.
Hugely. Thousands, even tens of thousands of dollars saved over an investing lifetime.
Okay, low-cost ETFs sound like a winner. But you mentioned mutual funds. How are they different? They're also pooled funds, right?
They are. Also professionally managed, pooling money from lots of investors. But the mechanics differ slightly.
How so?
Mutual funds don't trade throughout the day like stocks or ETFs. They calculate their price, the net asset value or NAV, just once per day after the market closes. You buy units of the fund, share in the profits or losses, and pay a management fee for that professional oversight.
And the risk profile varies a lot depending on the type of mutual fund, I guess.
Totally. The sources mention a few common ones, like index funds. These are actually a type of mutual fund or sometimes an ETF structure that just aims to passively track a market index, like the S&P 500 or FTSE 100.
So they're not trying to beat the market, just match it.
Exactly. That's the passive philosophy.
Yeah.
Because beating the market consistently is incredibly hard, even for pros. So index funds accept market returns, and because they're passive, their fees are usually very low, similar to index ETFs,
Right, compared to actively managed funds.
where the manager is actively picking stocks trying to outperform the market, which sounds great, but statistically, most don't succeed over the long term, especially after you account for their much higher fees.
So the advice for beginners is usually,
Stick with low-cost, broad market index funds or ETFs to start. Keep it simple, keep costs low.
got it. Okay, stocks, ETFs, mutual funds. What about bonds, the fixed income part?
Right. When you buy a bond, you're essentially lending money to an entity. Could be a corporation, could be a government.
You become their creditor.
Yep, you're the debt holder. In return, they promise to pay you back the principal amount on a specific date, the maturity date, and along the way, you get regular fixed interest payments.
Sounds safer than stocks. Lower risk.
Generally lower volatility, yes, but they're not risk-free. We need to be clear about the risks involved.
Okay, let's dive into that. What risks do bond investors face?
Two main ones beginners need to know. First is credit risk or default risk.
The risk the borrower just doesn't pay you back.
Exactly. The company goes bankrupt or the government defaults. That's why U.S. Treasury bonds are seen as super safe, while bonds from struggling companies, so-called junk bonds, have very high credit risk.
Okay, credit risk. What's the second one?
This one's really important, especially now. Interest rate risk.
Interest rate risk. How does that work?
It's an inverse relationship. When interest rates in the overall economy go up, the market value of existing bonds tends to go down. Because new bonds being issued will offer those higher interest rates, making your older, lower-rate bond less attractive to potential buyers. If you need to sell your old bond before it matures, you'll likely get less for it.
Ah, okay. So rising rates hurt the price of bonds you already hold.
Correct. So while bonds add stability compared to stocks, they definitely aren't risk-free, particularly when interest rates are changing.
That's crucial context. Okay, we've chosen our investment type. Maybe a diversified, low-cost ETF seems like the starter choice. Where do we actually buy it? The platform matters.
Hugely. And the options now are amazing, especially with investment apps.
Yeah, they're everywhere.
They've really democratized access.
Yeah.
Younger generations especially are using them to take control, often bypassing traditional banks with their high minimums or clunky interfaces.
That makes them so popular.
Ease of use, low or no commissions sometimes, the ability to buy fractional shares so you can invest with just like $10 instead of needing hundreds for one share of an expensive stock, plus access to global markets.
Our sources mentioned some specific European examples.
Yeah, platforms like BY's, DeGiro, eToro, Revolut, Oval Money, they're becoming really popular. The main thing is to check they're properly regulated in your country, understand their fee structure completely, and make sure they offer the investments you actually want, like ETFs.
All right, we've covered the prep work, the execution steps. Now, let's talk staying power, safety, psychology, keeping the gains you make.
Yeah, the market might give you returns, but your own behavior is often what determines if you actually get to keep them.
So true. Rule number one for safety seems to be that word again. Diversification.
Cannot emphasize it enough. It's your primary mechanical defense against risk.
Don't put all your eggs in one basket. We get that. But practically, how does a beginner achieve real diversification? Is buying one broad ETF enough?
It's a great start, but you can think deeper. Diversify across, say, 3 dimensions.
Okay.
Asset classes, mixed stocks, bonds, maybe eventually real estate or commodities. Geography. Don't just invest in your home country. Get exposure to the U.S., Europe, Asia, emerging markets. Sectors, spread across technology, healthcare, energy, financials, consumer goods, etc.
So if I buy a global stock ETF.
But that likely covers geography and sector diversification pretty well within stocks.
Okay.
Then if you add, say, a global bond ETF, now you've added asset class diversification too. It's about making sure a downturn in one specific area doesn't sink your whole portfolio. It smooths the ride.
Smooths the ride. I like that. Okay, that's the mechanics. What about the mindset? Avoiding emotional trading. This seems like the hardest part.
It often is. Patience is the superpower here. Behavioral finance shows us investors are terrible market timers.
We buy high, sell low.
Classic mistake.
Yeah.
Driven by FOMO, fear of missing out when things are soaring, and then panic selling loss aversion when things crash.
So if you're watching the market plunge, like in early 2020, and you literally feel sick, what's the coping mechanism besides just gritting your teeth?
Well, besides having the right risk level in the first place, the sources really champion a specific strategy, dollar cost averaging, or DCA.
DCA, how does that work?
Instead of trying to guess the perfect bottom to invest a big lump sum, which is impossible, you commit to investing a fixed amount of money at regular intervals, like $100 every month, on the first, no matter what the market is doing.
Rain or shine, you just keep buying.
Exactly. And think about what that does automatically. When prices are low, your fixed $100 buys more shares. When prices are high, it buys fewer shares.
Ah, so it forces you to buy more when things are cheap. Kicks the emotion out.
Completely. It automates discipline and stops you from making those gut-wrenching, fear-based decisions during a panic.
Smart. So DCA and patience, because the real growth takes time, right? Especially if you start small.
Absolutely. Compounding needs years, often decades, to work its magic. You need to keep learning, keep researching, yes, but also develop the discipline to just stay invested, stay the course, even when the market tests your nerves, which it will.
So the big takeaway is the market's always moving. You can't perfectly predict it. Don't try to time it. Just maximize your time in the market.
That's the mantra. Statistically, staying invested consistently beats jumping in and out trying to guess the peaks and troughs. Investing is a marathon, not a sprint. It's a continuous, disciplined learning process.
Okay, let's pivot a bit here. This is really interesting. If we're genuinely talking about starting from zero, maybe the biggest factor in your long-term investment success isn't picking the perfect stock. It's your ability to actually earn money to invest in the first place.
Right, your income, your human capital.
So securing the highest possible earning potential, that's arguably your first and most critical investment, wouldn't you say?
Absolutely. We're shifting from how to grow your first $100 to how to turn a $50K a year potential into, say, a $150K a year potential, maximizing the flow into your investment accounts.
And this requires looking at those pretty aggressive strategies needed to break into really high-paying fields, particularly finance.
Yeah, the source here focuses heavily on investment banking, private equity, hedge funds jobs, known for rapidly building wealth.
Okay, so for those high-stakes careers, what's the number one thing recruiters look for? The make or break factor.
Overwhelmingly, it's prior work experience, relevant experience.
Not just grades.
Grades matter, sure, but experience trumps almost everything. And the timeline is just brutal. Investment banking recruiting can start, seriously, sophomore year of university.
Sophomore year, wow.
Yeah, which means you need to have already built a relevant resume with finance-related internships from your freshman and sophomore summers.
But getting those paid entry-level finance internships as a freshman is incredibly hard, right? Firms want people closer to graduation.
Exactly. They see internships as expensive, long interviews for potential full-time hires. A freshman just too far out for most big firms.
So what do you do if you can't land one of those coveted paid internships early on? Just give up.
No, absolutely not. You cannot afford to just wait or do nothing. The key is having something productive, something high effort and relevant on your resume. It needs to show drive, interest, analytical thinking.
Okay, so what are the alternatives? The source laid out some pretty aggressive ones.
Very aggressive. Alternative number one is maybe the most unique. Offer to work for free at a search fund.
Search fund. Remind us what that is and why it's good for a student. Free labor sounds risky.
It's a specific setup, usually run by maybe 2 or 3 people in their early 30s, often with top MBAs and prior finance experience. Their sole goal is to raise money to buy and then run one single existing small to medium-sized business.
Okay, but working for free, what's the catch? What's the benefit?
The benefit is access and resume gold. The catch is you're trading your time for invaluable experience and connections. These search fund managers have elite networks.
And the work itself.
It's grunt work, honestly. Lots of cold calling potential sellers, screening databases, basic analysis, they call it deal sourcing or origination. But you get to put worked on deal sourcing and financial due diligence at a private investment fund on your freshman resume. No normal internship offers that level of responsibility or those keywords.
Okay, I see the trade-off. High effort, zero pay, but potentially high resume value. How do you even find these?
The source says, scour the internet, look for lists of active search funds, find the partners on LinkedIn, and reach out aggressively. Emphasize you're willing to work hard, remotely, for free, just for the experience.
Bold strategy. Okay, what if that's too intense or just not feasible? Alternative 2.
Much simpler, but needs discipline. Start a serious-looking blog focused on investing or publishing stock pitches.
A blog. Does anyone care?
Apparently, yes. It shows real, sustained initiative and passion.
Yeah.
You have to be Warren Buffett overnight. Consistency is key. Aim for like 5 to 10 well-researched long-form articles or pitches. Document your thinking.
And this actually helps in interviews.
The source claimed it came up all the time in hedge fund interviews. It instantly shifts the conversation. Instead of a generic why finance, really, it becomes, tell me about your thesis on company X that you wrote about. It proves you can think analytically.
Okay, that makes sense. You're creating your own track record. Any other ways to get noticed online?
Yeah, you could try writing and posting your investment ideas on established online communities. Places like Seeking Alpha or the Value Investors Club.
What's the advantage there?
These sites have built-in communities, often including actual finance professionals. If your idea is well argued and gets positive feedback or votes, that's external validation you can mention or even put on your resume. It's like getting peer-reviewed.
Interesting. Okay, next alternative. Starting your own small business, even if it's tiny.
Yeah, this one's mainly about resume padding and showing you have hustle and commercial sense. Failure is almost expected with startups, so success isn't the main goal.
It's about demonstrating you tried something entrepreneurial.
Exactly. Shows drive, maybe some basic operational or marketing skills.
What kind of business? We're talking low cost, right?
A super low cost. Simple e-commerce or drop shipping can be started for under $500. Tutoring. Freelancing basic skills on sites like Fiverr. The source even mentions just formally incorporating a simple LLC provides instant resume padding because it shows you engaged with the legal business side.
Clever. Okay, what else?
Investing your own money. Opening a personal account, PA, and actively managing it.
Why is doing it in college so important?
Because once you get a job at a real finance firm, you face major restrictions on personal trading due to compliance rules. College is the perfect sandbox to learn trading, make mistakes when the stakes are low.
And how do you leverage that for recruiting? Just say you invest.
Be strategic. Add a line under the interest section of your resume, something like active personal account management, equities focus, and maybe list one or two specific stocks you've researched and held, possibly even the return if it's decent.
Ah, why list specific stocks?
Because it's practically an invitation. It almost guarantees an interviewer will ask you about that stock. Why did you buy Apple? Walk me through your valuation.
And then you get to showcase your analytical skills, the stuff you learned from those books.
Precisely. You demonstrate your investment framework, risk assessment, everything. Even using a paper trading account like Thinkorswim and documenting your virtual track record can work if you don't have real capital.
Okay, lots of proactive options. What about things like certificates, CFA, etc.? Last resort.
Basically, yeah. The source was clear. Real experience, even the unconventional stuff we just discussed, is way more impactful. But certificates are definitely better than a blank space.
They show effort, at least.
Absolutely.
Yeah.
They show commitment and that you can handle rigorous technical learning. Passing CFA Level 1, for example, covers a huge amount of foundational finance knowledge. Even just passing Level 1 signals you're serious.
What else? Harvard Core.
Yeah. Good one for business fundamentals, accounting, analytics, economics. Also things like Bloomberg market concepts or, depending on location, maybe the Canada Securities course. They won't land you the job on their own, but they prove you're willing to put in the work.
Okay, so all these alternatives, the free work, the blog, the PA, they require massive effort. And networking, too.
Hyper-aggressive networking. If you didn't land that standard internship, you have to double down on outreach.
What does double down mean?
The usual advice is try to talk to one industry person per week. If you have no formal experience, the source says aim for 2 people per week, and not just firing off emails.
Right. Doing your homework on them first.
Exactly. Research their background, have smart questions ready, maybe offer value by showing them your blog pitch or your analysis on something. Be prepared.
And use that networking to find maybe less conventional internships.
Yes. Aim for fall or winter online internships you can do during the school year. They might be part-time, remote, maybe unpaid again, but they add crucial lines to the resume before that all-important sophomore summer recruiting cycle kicks off.
So the final word on this career investment angle, it sounds intense.
It is. It's about being incredibly proactive. Don't wait for opportunities, create them. Even without that freshman internship, you can still succeed. But you have to compensate with amazing grades, strong extracurriculars, and relentless execution of these high-effort alternatives and networking.
Basically, you need to work just as hard or harder than if you actually had that full-time internship.
That's the mindset. Always be building that resume. Hashtag tag, hashtag outro.
Wow. Okay, this has been a really packed deep dive. We've covered like 2 critical paths that run in parallel for building wealth from scratch.
Yeah, the disciplined steps for growing the money you have, and the much more aggressive path of maximizing your ability to earn that money in the first place.
Let's quickly recap the core investing steps for beginners. Number 1.
Commit to learning the basics. Read those books. Understand the concepts.
Yeah.
Set clear, realistic, Time-bound goals. Know why you're investing.
3.
Define your risk tolerance. Match it to your timeline and your gut. Choose the right investment types. Probably starting simple with low-cost diversified ETFs or index funds.
And 5.
Select a safe, regulated, user-friendly platform or app to actually do the investing.
The core message running through all of this seems to be about action and discipline. That quote again.
Start investing today for a better tomorrow. Believe, invest, grow. It really boils down to getting started and sticking with it.
But we want to leave you, our listener, with a final kind of provocative question that ties these two big themes together.
Right. So if you're truly starting with zero capital, where should your very first investment dollar, or maybe your first investment of effort, actually go?
Should it be that dollar into a low-cost ETF, letting time and compounding do their slow, steady work?
Or should that first burst of effort go into one of those aggressive career strategies, like butching your gut to land that search fund gig or building that blog, to dramatically increase the amount of capital you'll have available to invest down the road?
It's that ultimate trade-off, isn't it? Time versus effort, capital growth versus income growth. Where do you focus first when you have nothing?
Something to think about. There's probably no single right answer. It depends on your situation. But either way,
The journey starts with action, based on knowledge. So take what you've heard today, check out those books and resources we mentioned, pick your strategy, and keep learning.
absolutely, continue that financial education.